Right now, somewhere in Chicago, a 24-year-old trader just pressed a button. In the next 3 seconds, the price of orange juice changed in every grocery store within 1,000 miles of you. She doesn't know your name. She's never seen your kitchen. She doesn't care if you can afford breakfast tomorrow. But she just decided what you'll pay for it. This isn't a conspiracy. It's Tuesday. We talk about prices like they're facts of nature. Gas is expensive. Eggs went up. Housing is impossible. As if some invisible force of the universe just decided these numbers and we have to live with them. But prices aren't physics. They're decisions. And the people making those decisions aren't who you think they are. You probably assume it works like this. A company makes a thing, calculates what it costs to make it, adds a reasonable profit, and that's the price. Supply, demand, competition, done. That's what they taught you in school. That's what makes sense. But that's not what happens. Not anymore. Not for most of what you buy. What actually happens is so much stranger than that. And once you see it, you can't unsee it. Let's start with something simple. You walk into a coffee shop. You order a latte. It costs $5.70. You assume the owner set that price based on rent, labor, milk costs, maybe what the place down the street charges. Local decisions. Human scale. Wrong. That milk price, set 6 months ago by futures traders in New York who were betting on rainfall in Wisconsin and the cost of cattle feed in Brazil. The cup, its price depends on oil, which means it depends on OPEC meetings in Vienna and shipping routes through the Suez Canal. The coffee beans, those were priced by commodity brokers in London before they were even harvested, based on weather predictions in Colombia and currency fluctuations in Ethiopia that haven't happened yet. The owner of this coffee shop doesn't decide the price. They inherit it. They're downstream of 1,000 invisible decisions made by people who will never drink their coffee. And that's just coffee. That's the simple one. Most prices in your life are set by 3 overlapping systems. The first is commodity markets. The second is algorithmic pricing. The third is something called price discovery mechanisms, which is a fancy way of saying financial games that determine reality. Let's take the first one. Commodities. Wheat, oil, copper, pork bellies. These are traded on exchanges, like the Chicago Mercantile Exchange or the London Metal Exchange. Right now, there are more barrels of oil being traded on paper than actually exist in the ground. People are buying and selling wheat harvests that haven't been planted yet. The price you pay for gas next month is being decided today by traders who are guessing what other traders will guess about supply and demand. It's not about the actual stuff anymore. It's about the bet on the stuff. Here's where it gets weird. In 2008, a single trader in London named Jimmy Chung made so many aggressive bets on copper that he personally moved the global price. One guy, he created what they call a squeeze. He bought so many copper futures that when the contracts came due, there wasn't enough actual copper to fulfill them. Prices spiked. Every wire manufacturer, every construction company, every electronics maker in the world paid more because one trader in one office made one bad bet. He lost his job. You paid the bill. Now add computers. In the last 15 years, most major retailers and service companies have switched to dynamic pricing algorithms. Amazon changes prices on about 2.5 million items every single day. Not because costs changed, because the algorithm is hunting for the exact maximum you're willing to pay. It watches your behavior. It knows if you're shopping on a phone or a laptop. It knows if you're in a rich zip code. It knows if you clicked on the item twice, which signals desperation. It adjusts in real time. 2 people looking at the same product at the same moment can see different prices. Uber pioneered this with surge pricing. They called it matching supply and demand. But here's what they didn't advertise. The algorithm doesn't just respond to demand. It creates it. If the system notices that people in your area keep paying higher prices on Friday nights, it starts raising prices on Friday afternoons to train you into accepting the new normal. It's not reacting to the market. It's teaching the market what to bear. Airlines do this too. That ticket price you see, it's been refreshed 40 times since you opened the tab. The airline doesn't know what the seat is worth. It's guessing what you think it's worth. The price isn't discovered. It's negotiated in real time by a machine that's better at this than you are. But even algorithms are downstream of something bigger. Let's talk about central banks. The Federal Reserve, the European Central Bank, the Bank of Japan. These institutions control the price of money itself. And when the price of money changes, everything else changes with it. When the Fed cuts interest rates, borrowing gets cheaper. Companies take on debt to expand. Investors chase returns. Asset prices inflate. Stocks go up. Real estate goes up. But wages lag. They always lag. So the price of shelter rises faster than your ability to pay for it. That's not an accident. It's a feature of the system. Between 2008 and 2021, central banks around the world created over $20 trillion through quantitative easing. That money didn't go to you. It went to banks who lent it to corporations who bought back their own stock, which made their share prices go up, which made their executives richer. Meanwhile, you're standing in a grocery store wondering why a gallon of milk costs twice what it did 5 years ago. The answer is, they printed money and gave it to people who don't buy milk. And then there's coordination, not conspiracy. Coordination. It's legal. It's called price signaling. Here's how it works. Let's say you run a massive chicken company. You want to raise prices, but you're afraid your competitors will undercut you. So you go on an earnings call. You tell investors, we're seeing cost pressures. We may need to adjust pricing in Q3. That call is public. Your competitors hear it. They go on their earnings calls and say the exact same thing. Now, every chicken company has pre-announced a price increase without ever talking to each other directly. When the time comes, they all raise prices within days of each other. No collusion needed, just coordination through public signals. The Department of Justice knows this happens. They've written papers about it, but it's almost impossible to prosecute because nobody broke the law. They just all watched each other and moved together. This isn't just chicken. It's airlines, rental cars, hotels, pharmaceuticals, industries with a small number of big players. Oligopolies. They don't have to form a cartel. They just have to pay attention. So let's zoom out. You're not paying what things cost. You're paying what the system has decided you'll pay. And that system is a web of commodity traders betting on weather, algorithms harvesting your behavior, central banks adjusting the price of money, and corporations signaling to each other through quarterly earnings calls. None of them see you. None of them think about you. You're an abstraction, a data point, a unit of demand. And here's the part that should bother you. The system is getting tighter, faster, more automated. There are now AI models that predict price changes before humans even know why. High-frequency trading firms execute millions of trades per second, shaving microseconds off reaction time to capture arbitrage opportunities that didn't exist long enough for you to blink. The gap between the decision and your wallet is collapsing. This matters because prices aren't just numbers. They're permissions. They decide who gets to eat well, who gets to live near good schools, who gets to retire with dignity. When prices are set by systems that don't see people, you get outcomes that don't make sense for people. Insulin costs $10 to make and sells for $300. Rent in cities rises faster than wages every single year. A bag of groceries that cost $60 in 2019 costs $95 now, even though corporate profit margins are at record highs. These aren't accidents. They're outputs of the system working exactly as designed. So here's the question nobody wants to ask. If prices are just decisions, why are we pretending they're inevitable? If a 24-year-old in Chicago can move the price of orange juice with a button, and an algorithm can charge you more because you look twice, and central banks can create trillions from nothing, then who decided this system serves you? The answer is nobody. And maybe that's the problem.